Just in general, I think the entrepreneurial road is a very tough one to walk. And the amount of support that's needed from a pre-investment point of view can't be emphasized enough. I think we speak a lot about accelerator programs and incubator programs, and probably not enough people know what those are. So I just want to elaborate a little bit on that. So from an accelerator point of view, the idea is that it should be quick turnaround. And so, as I mentioned earlier, it's either some sort of accreditation or certification that's required to unlock a market. Whereas an incubator is over a longer term, 12 to 18 months, where you're taking a business which could be at concept stage and walking that pre-funding journey with them. And even creating or opening up the markets for them. This is something that DFIs do. But I think understanding that as an entrepreneur, it's a tough journey to walk. And the support that's provided by DFIs, in my experience, is really underplayed. Because getting the funding is one thing, but what do you do after that? And to not take for granted the support that comes with that, because it's, as I said, it's about building sustainable, viable businesses where development is not just being able to say, there's this woman-owned business and we've created 50 jobs, but it's looking at the broader development that's happening from a community point of view as a result of that funding. Sometimes. So generally, for the businesses where I've worked, it's a form of grant funding. The non-financial support, non-financial for the entrepreneur, because obviously somebody's got to pay for it. And so our view is that you can't give someone funding and then expect them to pay you for that same service. You're just taking your own money back. That cancels out. It doesn't make sense. And so it's that additional support which is over and above the funding, which the entrepreneurs generally don't need to pay for. There are instances though where to show skin in the game, to show their commitment, they would be asked to pay a portion. So for example, if it's identified that it would be great for a said entrepreneur to attend a course at Gibbs, as part of their development, and the agreement is the DFI pays 90%, they pay 10%. Those are the kind of things that's negotiable, because it's not just about that point in time. The things that are learned at any business school, you'll still recall 5 years down the line, and by that stage you may have repaid the facility. And so our view is it's not just about enabling the entrepreneur for a point in time, but it's almost ongoing. Yeah. It's different for businesses which are at different stages. So for a startup, for example, we all know how they're viewed as high risk. And so if you were to price that loan, nobody would take that finance, it would be too expensive. So in that case, the option for the entrepreneur is either to take, for the DFI to take an equity stake, which makes sense because at the end of 5 or 7 years, there's an exit strategy, and it's a partner, direct partner in your business to assist you as the business grows. But then there's also subordinated loan, where if the business is kind of at growth stage. So not startup, but not established, but in that middle ground where a loan would actually cripple the business, but equity doesn't make sense for it. And so in that case, subordinated loans are also quite useful. The important thing to remember is that these entrepreneurs generally in the development space are the unbankable market. And so to approach a commercial bank, really, they would either not get the funding or they'd be priced right out of the market. And so naturally, the funding in the DFI space would need to be lower than that of a commercial bank. So it's a bit of a schizophrenic thought, because on the one hand, you're taking on high risk, and high risk tells us that you need to price for that. But on the other hand, you're taking on people who are deemed unbankable, and so it's almost giving the opportunity. So there's that mind of, yes, we're risk takers, but we're actually quite risk averse, and so marrying those two schools of thought is kind of a DFI. It's like your head is not, it's like shaking, but generally the pricing would be lower. It depends. So, if you're an entrepreneur who's looking for working capital or bridging facility or contract finance, generally there is no security to put up there as such. They could perhaps ask for an unlimited suretyship or a session of a bank account or a session of stock. But if we're honest, those aren't. It's not real security in the true sense of the word. Where DFI does give funding for asset finance, for example, if you're purchasing equipment or machinery, they would, in that case, take security by either registering a general covering notarial bond or a special notarial bond. And I think I just need to like caveat that because it's important to think about where the funds for the DFIs are coming from. Generally, if they're not from an endowment fund, there would be funds that belong to the people, either through tax or some other form. And so it's important to be able to take that money for only the reason of being able to then recoup it and be able to fund another business. And so that for me is the main reason that a DFI would take security. It varies. Unfortunately, it probably does take much longer than it should. Especially if you're thinking of the supply chain space where an entrepreneur has either received a contract which they need funding for, or a tender, and so the turnaround time there needs to be quick so that they can execute on the contract. There tends to be quite a bit of backlog. So as a result of the influx of applications, that's generally where things take long, because the filter process is from application, filter, who's sent through the right information, desktop analysis, and then you start engaging with the client for due diligence. So generally, the period can take anywhere from 6 weeks to 6 months, but it depends. There's a lot of moving parts. So was all the information available? Has the client been communicating with the person that's allocated to the job? And also has all the information that's been submitted follow all the right requirements? So those are the things generally, and then of course the capacity of the team that's looking at the deal. Those are the things generally that make the process long. It is a problem, and it is a frustrating point for a lot of entrepreneurs, because the conversation isn't about is there funding anymore. Everybody knows that there's funding, but it's about, will I get it in time? And I concur with that point, and it is something that needs to be changed within DFIs at large.